Stirling, the S&P 500 index has just touched 2,000 for the first time in the US. Is that a pretty positive sign for global equity markets?
Andrew, I think it really is. I'm actually really excited about the next 6 to 12 months. But I guess the important point for investors and advisors as well is understand what's really going on. And as we've talked about in the paper over the last few months, the US Fed has pumped a lot of money into the system. We're seeing a once in an 85-year event with regards to what the quantitative easing, the effect that's having on markets.
Yeah.
And it is a very exciting time, but you do have to have a good grasp of the macro.
Do you feel that the Fed has got its hand quite well on the levers in terms
Absolutely.
of tapering the QE and making sure that we don't suddenly have US
Absolutely.
rates kicking up?
Absolutely. Saying that, we've all seen what happened last year with what they call taper tantrums. Whether that happens or not at the later part of this year, who knows?
Yeah.
But what's important is they've been very, very prescriptive about how they're going about it. The markets know it's coming. Different parts of the market, whether you're talking about the bond markets or equity markets, are reacting accordingly. And again, if you have a good grasp of the economics and the whole macro picture, it's quite easy to see where markets should be heading in the next 6 to 12 months.
And essentially the US economy is going to be one of the stronger, certainly major economies in the world. I mean, what we've been noticing here has been a bit of warning among some investment commentators that the US markets run pretty hard.
Yes.
So, perhaps lighten off. You sound to me like somebody who's saying, yes, it's run hard, but it's got a lot further to go.
I think it does. And a good indicator is, as we talked about in the paper in the last few months, to look what the institutional participants are doing. And in America, traditionally, October is a very, very volatile month. A lot of them come back from summer holidays in the end of September, whether they be hedge funds or pension funds, etc. And they, this year, will know where QE is heading. There's only another month ahead of them with regards to the end of the tapering. And we should have a clear indication where the S&P 500 and the Dow Jones should be.
Now, moving to Europe, that's been a bit of a basket case.
Very different story.
It's now moving just into positive territory.
Yes.
But can I assume that you've got to be pretty careful investing in Europe?
Absolutely. And I was actually at a conference yesterday, and the key point of that is to compare it to Japan. And the point is, there's 2 points to look at the European market and the Japanese market: is asset inflation and real economy inflation. And what we've seen is the real economy in Europe is most definitely not inflated. They're concerned about even deflation.
Yeah, correct.
But asset prices have been inflated, which is fine. But you have to understand, when you make an investment or exposure towards Europe, that your allocation in your investment may not reflect the real economy, which from a short-term point of view is not a big deal. But when you're looking at, with regards to maybe a superannuation fund, for example, here in Australia, you have to understand the difference between the two.
So you're really saying the European economy has got evidence of distortion?
Yes, very much so. And again, that's what we've been talking about with regards to quantitative easing and the monetary policies. Exactly like the experience many people had with regards to Japan over the last 20 years.
Yeah, and on China, I know you spend a lot of time in China, we're seeing the growth numbers easing back to the top end of the sixes, but that's not got you worried?
No, not at all. And again, as we've been talking about over the last year, that the Chinese are moving from a manufacturing to a consumption-led model. They're facing all the normal challenges, but there's over 1 billion people still growing at numbers above 5%, and I can't see how that's a bad problem at all.
And would you also say that this anti-corruption campaign that's happening in China is something that hasn't been really as well reported as it could have been, and that it's actually a serious positive for their market?
I think it is, and I think they need to go through those structural reforms. We hear patched parts of what's actually going on here in Australia or in the Western press. But again, it's an economy that came from nothing 30 years ago and is transitioning in a relatively rapid period of time. And it's needed, and I'm sure there are good and bad stories out of that change, but it's something that will help us all in the long term.
And these numbers are annual numbers in the high sixes.
Yes.
Are you're comfortable that they really do exist? Because I take it that there's so many levers that the regime has got that they can reverse engineer to a number, really.
Of course you can, but you could argue that the same happens here in Australia or the US numbers as well. But again, the economy is transitioning. They do need to cool down certain parts of their market, so that's not a bad thing at all. Inflation in China is actually relatively stable, which is a very, very positive sign, and that's the exact opposite experience of what Japan and Europe is facing at the moment.
So in summary, Stirling, you're saying that it's a pretty benign global environment right now for Australian investors if they're
Yes.
if they're well organised enough to diversify offshore.
Yes, I mean there are flag posts about what the next 6 to 12 months should be, hence why I'm excited about the horizon. We will have volatility coming back into the market, but again, if you're prepared and you understand the context, there's no reason why as an investor you shouldn't be prepared to find opportunities in the next year ahead.
Stirling, thank you very much.
Thank you, Andrew.